Happy New Year, everybody. We are going to talk about Rising. That was the acronym for 2025. How did it do? And what are we going to do about it? Today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, and Happy New Year. And I think it is time, a good time, for us to discuss Rising. Rising was the acronym that I chose at the beginning of the year, and forgive me because I should have actually had this up already. I'm going to pull this up right now on my screen, hopefully. I thought I just opened it. And okay, yeah. This is it. Okay, so there's the cumulative total returns we have here. Let's see what we've got. All right. So it looks like, and let's just make sure that this is right. The total return for the year. This number over here, this column is taking a look at the performance relative to the total returns for the S&P. And by the way, you might find this interesting. Maybe you do, maybe you don't. But this also will include, because I've been asked in the past to, specifically by Steve Grasso on CNBC, to keep track of this and provide periodic updates. So it looks like the total returns for Rising, and I'm just going to confirm, there should be 6 tickers in it. 7, excuse me. CNBC only allowed me to have 6, but we discussed 7 because I wanted to make sure I kept gold in there. You can see that video from the beginning of the year. 1, 2, 3, 4, 5, 6, 7. Okay, we've got 7. And those were RSP. RSP, for those that don't know, is the ETF that tracks the equal weight S&P 500. We're going to get back to that in a second because some of the things that I believed at the beginning of 2025, at the beginning of this year, I still have some of those same views going into 2026. IBIT, which is the ETF that tracks Bitcoin, that did not turn out so well. I was long Bitcoin in the previous year's challenges as well. That's down almost 6.6%. SCHH, this one I'm definitely going to pull because when I came up with this, this was an ETF that, I guess arguably, my own firm competes with it, so that would be a good reason to ditch it. INDA, this is the India ETF. Whether this is a really effective one to track the Indian stock market is something else that we can certainly take a look at. Nance, this is the congressional trading tracker for the Democrats, named Nance after Nancy Pelosi. There is also a Republican version. The Democrats have typically outperformed the Republicans. They outperformed the market, and I believe they outperformed the Republicans again this year. But I don't know what's going to become of this because Nancy Pelosi is retiring. I actually know the fund manager who manages this. I just wished him a happy new year as it happens. I didn't bother to ask him yet, though, what now that she is retiring. Are they going to change the ticker? Are they going to change who they're following? Alphabet, Google, that was in here, and GLD. So the net result of all of that was 26.54%. Up on the year, outperforming the S&P by 8.27%. Last year, I won the acronym challenge on CNBC. As we can see, I am not going to this year. And the reason for that is that a couple of my colleagues from Fast Money have absolutely crushed it. And the 3, by my work anyway, that have absolutely crushed it. I would say Courtney Garcia also did well. I think if you do better than the S&P generally, I think that's quite good. But the ones that really crushed it were Guy Adami, up 35.4%, outperforming the S&P by 17%. Karen Feinerman up almost 41%. And we can take a look at what they did that performed so well. And in fact, I should probably, we'll look at this in just a second. We'll take a look at their best performing stocks. Steve Grasso, who was neck and neck with me last year, so all the way up to the finish, a respectable return of almost 15.9%, but that did underperform the S&P by a couple hundred basis points. Same thing with Bono and Eisen. Tim Seymour's results about 10%, which under normal circumstances, if you're getting 10% a year, that's not terrible, but on a year when the S&P is up 17%, it's a little bit harder. And Carter Worth had plop here. Now, I want to just point out a quick caveat here on this, and that is that my understanding, if I remember the acronym, was that these were names that he had selected as shorts, that he had picked a host of stocks that he was going to short for the year, sort of like his biggest short ideas for the year. I could be wrong on that. And so on this one, we're just going to set that one aside. That's how I remember it, and that's how I reflected it in this spreadsheet. But I want to double check that because while I think these were interesting names, one could argue interesting names on the long side or the short side. Shorting stocks is something, as you know, I don't recommend that very often. The trend is certainly not your friend. Stocks generally rise. The value of the dollar, all else equal, generally declines. The economy generally grows, albeit somewhat slowly. So shorting stocks is a very, very difficult game. And it is also worth noting that when it comes to shorting stocks, that's usually more of a tactical trade. So even if he was suggesting that one should short these, were there instances throughout the year where he would have recommended covering those shorts? My guess is the answer to that is yes, because we had the post-Liberation Day sell-off that was extremely sharp. If memory serves, a number of these stocks actually fell quite sharply at that time. And so, for the purposes of the acronym challenge, you basically have to wear these things all year long, whether you like it or not. And that probably deserves a little bit more attention. Okay, so let's just take a look at some of the better performing names. Let's just take a look at what Guy Adami did to start the year and talk about whether we think these are still good trades. So his best performing names, it looks like, were Alibaba and Uber. And let's have a look at each of those. He also has Toyota Motor in there. We can also consider whether some of the names he's picked deserve some attention. So let's just I don't think it should take us too long to run through these. By the way, if you have any questions about them, I'm going to pull up my social media stuff over here so we can take a look at that at the same time. Let's take a look at Baba first. And first we'll take a look at valuation. So we'll just talk about what my general criteria are. This is reflected in yuan, so I'm going to convert this to dollars. So we're looking at this chart together. Does it meet or beat my general investment criteria, even at its current price, which is sharply higher than it was? The short version of this is, it looks like the answer is very likely going to be yes. We have this situation right here where there looks like there's forecast to be a one-year decline. That's the year we're currently in, actually, because their fiscal year ends in March, so we're about to enter the fourth quarter. But it looks like as we look ahead to the next year, that they're going to be resuming, the path to respectable EPS growth. We've got good top-line growth here. 7.5% is anticipated for the year that we're currently in. Next year's forecast is close to 11. And in terms of free cash flow, again, this is reflected in dollars. So if you're going to go and take a look at this thing yourself, just sort of bear it in mind. I prefer to look at it in dollars. Number one, because you invest in dollars if you're buying an ADR. like Baba. And secondly, it also gives us some sense of scale. Like if you wanted to know how big a company is Baba, how big is it relative to, say, an Amazon? Well, the answer is it's about a tenth the size, right? So we're just taking a look at this, $8.5 billion worth of free cash flow relative to an enterprise value of about $290 billion. So we've got free cash flow of about 3%, free cash flow yield of about 3%, which is fine. It's not great, as a number of the companies we've taken a look at recently are closer to 5. Also, it might be worth, if you're interested, and sometimes I do look at it this way, in this particular case, this is a company that carries fairly substantial net cash. Net cash is about $60 billion. So it might also be worth taking a look at the company's earnings ex cash. So on that basis, that's going to work out to, so if you strip cash out, we're looking at about 121 for, let's call it 121.50 a share versus $9, let's say, in round numbers, in anticipated adjusted EPS for the next fiscal year, and probably a little bit less than that for the next 12 months if we want to just do it on a calendar year basis. That's 13.5 times forward earnings. So, on that basis, not bad. Not bad at all, I would say. Okay, so what was the other one we were going to look at here very quickly? Uber. Ah, yes, Uber. And we've talked about Uber a couple of times. So let's take a look at this thing. How are we doing this year? Obviously, it's up a lot, but I didn't think it was doing so well recently, and it does not look to be. Would this be an ad for me here and now? And the short version to that is no, it actually wouldn't. For one thing, it's trading below its long-term moving averages. We can evaluate that from a special situation standpoint from time to time if we choose, despite the old saw that nothing good happens below the long-term moving average. However, I think this is a rather interesting space. One of the things that came to my attention today is that we have a new law going into effect here in California this coming year. And this new law, it's intended to be consumer protection, but one of the things it's supposed to do is make it a lot easier for consumers to get a full refund on their purchase when they order from things like DoorDash and Uber Eats. There has to be essentially a proof of fraud in order to decline a refund. Maybe everybody's going to play by the rules and be honest about it. Maybe they won't. But on balance, if you essentially make it easier for consumers to just say, I'm not going to pay for this reason or that, and you need to prove that they're being fraudulent to decline, to refund their money, my suspicion is that's going to lead to some abuse here or there. Whether it does or doesn't, we can only do one thing, and that is to say that the expected value for the businesses involved is negative. If you have a situation where it's only, let's say everybody's good, nothing changes, then it has no value. It has no impact on the valuation of these businesses. However, if it does anything to move the needle at all, and presumably the lawmakers who put it into effect thought that it would because they thought it was necessary, which means that they thought it was necessary that you're going to have more refunds. All of this creates a deterrent. Creates a deterrent for the restaurants that are selling their products. And if they become less inclined to use this as an avenue, then that's not good for the delivery services either. Put all of those things together, it's not looking like the street is expecting year-on-year adjusted EPS growth. We can see that there's an anticipated lower margin. It's not terribly valued, right? So if you own it, I'm not telling you to run out and sell it because it's trading at about 20 times earnings, maybe forward earnings, and maybe slightly less. But it is a little bit problem. And this has better free cash flow, by the way, than BABA, which we were just talking about. I said that was decent at 3%. Well, if that was decent at 3%, this one's better than 5, right? Well, better than 5. So what do we have here? We'll just call it, let's call it $10.5 billion over 170 or something in that neighborhood. 6% free cash flow. So it's not unreasonably valued, but it's just the combination of the fact that it is below its long-term moving averages, that we have this unknown in a very large market, just gets me a little bit less excited about it. So good win, good call by Guy Adami on this one, but probably not going to team up with anybody on getting along that one. So moving on, I'm just going to take maybe the best two. Although actually I should probably be looking at any name that outperformed the S&P that was selected. So Karen had Citi in here. This makes sense. The banks were relatively cheap to begin the year. That's the first thing. Also, actually, she had BABA in here. So we've already talked about BABA. We used to like that one even now. So the banks were cheap. That's the first thing. The value of the assets on their balance sheet have increased along with other types of assets. So that's a real positive. And that means that probably their price to tangible book hasn't changed a great deal year on year, which means that they're probably still reasonably valued in that sense. In terms of their money-making capabilities, that has improved because the short end of the curve has come in and the long end of the curve hasn't really. And what do banks do but borrow short and lend long, right? So if you're thinking about net interest margins, this is a positive environment for banks. And, that's a dividend degenerate said, fraud going to run Uber out of Cali. Yeah, I hope not. My kids use Uber quite a lot. Not always the way they should, it should be said, but and DoorDash, it turns out. One of my sons ordered DoorDash. I think he ended up paying $30 for a burrito. We had to have a talk about that. In any case, I think that the banks remain relatively well positioned. In many cases, they were increasing their loan loss reserves. We know that there was some stress on the periphery for consumers. We saw that in things like auto loan delinquencies and so on. But that's going to be less of an issue probably for the largest of the money center banks. So I'm talking about the Bank of America, JP Morgan, Wells Fargo, and Citi, and so on. BABA, we already talked about that. URI, did URI beat what was the total return for the S? And let's just double check this. Let's just look at it this way. We'll do SPY, total return for the year. So that was 17.7. So URI didn't quite beat it. But URI was appearing on one of my screens. So let's just take a look at this one really quickly. Still above the 200. It's bouncing around on this line right here. If it breaks below, I think that's a little bit problematic, and I wouldn't be crazy about it. But we're hanging in there, and the 50 is coming down. So there's a chance that we might be in an okay place, and it would probably meet my screens on the long side from a technical standpoint. But this is a name that I've often been interested in from a fundamental standpoint because they're quite consistent in terms of their growth profile. So this year was a little bit slower. As you can see here, 5.2%. That's a little bit slower than prior years, but it looks like most of the street is anticipating that their top line growth is going to get back above 6. This is a number that we like. We're going to have very low but still double-digit EPS growth, and respectable free cash flow yield and respectable free cash flow growth. So let's just talk about that second part first. Looks like, and this is a name that shows up on my screens quite consistently. So every single day, and I'll do that today if people are interested, so we can just sort of get an end of year level set and just say we'll screen for some of these things from a technical standpoint, we'll screen for some of these things from a fundamental standpoint, and just sort of see what percolates to the surface. But this is a name that often does show up. So we're looking at 12% year-on-year free cash flow growth and a free cash flow yield of almost, about 5%. Relative to the market capitalization, although I also like to look at it on an enterprise value basis. Company carries about $15 billion in net debt, so that's going to be a slightly lower number, but still decent. 3.9, so just under 4% free cash flow yield relative to enterprise value. So it didn't quite meet the criteria for beating the S&P, but it's a name that Karen has long liked, and I think they've done a decent job, and it looks like their growth path, if not getting back to prior levels, is forecast to at least improve year on year. She has Boeing in there, and Boeing has clearly done quite well. Maybe not surprising given how badly it had done historically. I have indicated that here my concern was just the level of debt that the company is carrying. It's a little bit of an issue, and I just feel like this is a business where the management really has made some poor choices. They've obviously made some big changes that might be worth it. They still have to do some work turning around. They have not completely corrected the negative free cash flow picture. Next year, they're forecast to do about $2 billion in free cash flow. That's about 1% relative to enterprise value, and solid top line. And look, it's a duopoly. It's basically in the larger aircraft, which there is a backlog of orders. It continues to be a growing market. It is essentially just Boeing and Airbus. So I don't blame people for wanting to get involved, but I have a bad taste in my mouth, admittedly, with this business. And this is a company I was long and sort of in favor of, with the one exception that I did take issue with the fact that they didn't seem to be innovating anymore. This is just partially a function of consolidation. As the U.S. aircraft manufacturing business has consolidated, I felt like that discouraged these businesses from developing new aircraft. So we weren't seeing things like the 787, which was an all-new design. We weren't seeing things like the 777, which came before the Dreamliner did, an all-new design. And their competitor to the Airbus A320neo led to the 737 MAX disaster, which was, modifying the engine placement on the wing and using software to change how the aircraft responded relative to that change, and that obviously was problematic. If you're basically trying to take new engine designs and put them on an airframe that is in fact older than I am, which the 737's original design dates back to the 60s. So, not that those engineers weren't building a good aircraft, but we now know that more efficient engines have much wider engine nacelles. They're just much bigger in the front, and the fact that airplane sits very low to the ground, that and some other things about it probably deserve a rethink. I just didn't care for that. And it's not all their fault, by the way. The way the regulations work, it's very costly to train up pilots on a lot of different aircraft types. And so it is not just important to keep the fuel consumption down for the airlines, but also to the cost of pilot training is such that if they can minimize additional training hours for the pilots. That's an important economic consideration for the airlines, and that was an important consideration for Boeing when they decided to make that. But for these reasons, I'm not totally enamored. Okay, so let's just take a quick peek over here at. Did Steve have anything that really took off? So X, but that doesn't do us any good. So what is X? X is U.S. Steel. U.S. Steel got acquired, so that's over. That not really anything to talk about there. So the best performing name in his in his acronym that we could take a look at is Reddit. So let's take a look at that. All right. Well, let's take. You know what? Why not? We'll take a look at the chart first. It's usually helpful. This should be in a good spot technically, which we would expect that it would be, given the fact that it's up over 40% on the year. How do valuations look? And you know what the interesting thing about this exercise is that it reminds us what a powerful impact a growing business has, and the reason that we're interested in investing in them in the very first place, right? So this is a business now forecast to make $722.5 million for the full year. They had never made money before, and they've actually made money over the trailing 12 months here. They're expected to make $1 billion next year. So at that price, it's trading at about 40 times next year's adjusted net income, and they are also forecast to grow earnings at very close to that same number, 40%. So that gets us to a price earnings growth ratio, a PEG ratio of 1, which is a good place to be. That's kind of your bogey, right? If you can get it. The year after, forecast to slow down a little bit. Free cash flow yield isn't going to be quite as exciting. This is more of a growth story, but it does kind of demonstrate what it is that, the reason why sometimes paying 30, 35, or even 40 times earnings for some businesses isn't really such a big deal, and that is because at the pace of growth, very soon, you're not paying such a high multiple. Indeed, this is a very good example of that. You would have been paying considerably less for this business a year ago, and this is what you would have ended up with. So essentially, you would have, at the end of last year, paid $29 billion in terms of market capitalization for what will probably turn out to be about $1 billion worth of income. So you would have been paying, you ended up paying 27 times forward. It is not a terrible number. And this year, I should stop sticking. It's my habit. I keep putting it back in its case. So it's missing a foot now because I keep doing that. But now we're looking at, what did I say? 1730. No, 1731. 43,560. So not. Yeah, 31 times forward adjusted net income numbers for next year. That's, again, it's a PEG ratio of 1. So still reasonably valued. Even here, even up 40%, because the company continues to grow. All right. Just a couple more of these to get through. Bonawyn's best name was Broadcom. And what else has he got in here? Oracle beat the market. And anything else? No. Broadcom, I don't really know that I need to get into that story too much because, one of the year's best performers, and you guys have probably heard that story, beaten utterly to death. Oracle, I'm not jazzed about this one, I have to say, simply because, the company's taking on a tremendous amount of debt. And there also seems to be a little bit of distraction in, in the Ellison family. Are they going to be all in on the Oracle business, or are they going to start really getting into Hollywood? Larry Ellison seems to be a very engaged and active business person, but he is getting up there. And his son obviously has his time and attention focused elsewhere. That combined with the debt, just not for me. Electronic Arts, Dan Nathan. This was one of his best trades. What else has he got in here? Intel. So Intel, and you guys have heard me say this before, I think. I have again, the problem that Intel faced was not a problem unlike the one that Boeing faced. So are these companies going to be run by engineers, or are they going to be run by business people? And the irony is that, those of you watching and me sitting here, who are we, but, people essentially just trying to be business people, finance people, deciding whether it's a good investment or a bad one. Who are we to criticize business people for running a business? But the question is, would I be well suited to run Intel? My inclination to that is no. I probably would not be. I think that the people who should run these businesses are the engineers who design chips. Let them figure out what is going to be the next innovative product so that people get excited when they see a computer box that says Intel inside, rather than finding ourselves in the situation where we do right now, where as often as not, you're almost hoping it says AMD instead. They have not won that back yet. So they are not in a Broadcom spot. They are not in an NVIDIA spot. Obviously, I realize that GPUs are not the same thing necessarily as what Intel's strengths are theoretically. But they just don't have this super sort of proprietary spot that they occupy. In fact, if I'm going to be in more of a commodity business, I might prefer Micron here to Intel. Okay, Courtney, Goldman Sachs. We already talked about that with the banks. Same thing applies here. Baba, we already talked about that. So they were sharing a lot of ideas. Isn't that interesting? There seems to be some commonality. AMD, well, we like AMD. This was a good performer for Tim. How did Tim's performance do not so well? I mean, he's got AMD, he's got Boeing. I see. Nike, DEO. So he's got a couple big losers in here. So Boeing, we just discussed that. AMD, like the business. Do we like the valuation? We could cover that pretty quickly and just see where we're at right now. 651. So, say 215, 6.5. 33 times with a 64%, 32% top line growth, peg 1. Yeah, I mean, they continue to execute, not unreasonably valued based on their growth rate. Probably not the best idea to have everything in these high growth names, which we're going to get to as we talk about my acronym. But okay, and then Carter's names, for what it's worth. Palantir. Yeah, I wouldn't short Palantir with my enemy's money. Isn't this interesting? So he shorted OC. That's down 33%. That's a big. Let's see when he might have covered that, or if he should have. That was a good short, Owens Corning. And the issue that we have here, not the best chart for Americans generally, because of course Owens Corning is tied to home building. And for this trade really to turn around, we need housing affordability to improve. And for housing affordability to improve, you kind of need lower rates. And we don't really have inflation to justify lower rates. And lowering it at the front end isn't going to do that much for the 30-year fixed, because that's going to be priced more off the 10-year. So I don't know that this one has fallen enough that one should be thinking about buying it, because I'm not expecting good things, and I'm not alone, it seems. So as we take a look at this, we can see that the street's overall view is that the decline that we saw this year is going to continue for another year. And we're going to get down in this neighborhood. It's not an expensive company at 10 times earnings, but never a good thing when you have declining free cash flow. We do. Declining earnings, we do. Declining revenues, we do. And knowing what the backdrop is that's causing that, do we see an end in sight that is necessarily going to bring the long end down precipitously in the near term? We don't. Put all of that together, it's kind of hard to get excited about it. I think this is a situation where we're looking for what Carter would often refer to as a bearish to bullish reversal. So we're kind of lingering around this 200. He likes to use the 150. I'm going to stick that in. That tends to be his barometer. For my own use, partially because Bloomberg defaults to it, and partially because I actually have to go back and calculate manually the 150 if I am doing more involved studies going way back in time rather than just using the factor analysis tools that the system has built in. I tend to use the 50 and 200 more often just for convenience, not because it works better. Carter has told me, and I'm inclined to believe him since he does more of this than I do, that the 150 is actually a better indicator than the 200, and the 50 is not really that much of a long-term moving average. But what you're looking for is for this essentially to come close to crossing. Looks like we had a couple false starts in here, but that is something to keep your eyes on. Okay, so with that, I think we can now move on to oops, my names. Where did I put them? What did I do with that chart? Here we are. And okay, RSP. Let's start with RSP, the equal weight ETF. My logic at the beginning of the year, when I was thinking about RSP, was that we had a couple areas in the market that had arguably gotten a little ahead of themselves or extended. And if that was true, it seems like that has continued somewhat. I have to say that one of the things that has occurred to me more recently as I looked at this as a portion, and look, overall the performance was good. I mean, I'm not gonna complain about 26.5% over the year, particularly if, and this is a good year, so the S&P is up more than 17. I'm not going to complain about results that are up more than 8.25. But as I think about RSP and what I didn't give enough thought to, and that is that I often describe the S&P 500 as sort of an auto-adjusting basket of the economy's winners, publicly traded winners, which it is. And what that means is because it's cap-weighted and, it flushes out losers and introduces winners, and the more they succeed, the more heavily they're weighted. And as other companies lag, the less they're weighted. That really was the issue, I think, that was wrong when I thought about RSP at the beginning of the year, is that I didn't think about that enough. That wanting not to be overly weighted in some of the things that had come as far and fast by just saying, okay, fine, I'll trade equal weight instead. The mistake I was making there was that meant that those stocks that were falling, that remained in the index, call it the Owens Cornings of the world, that rather than falling from a small percentage weight of that basket to an even smaller one, when you trade something like RSP, essentially what you're doing is you are buying more of the stocks that are losing and you are selling off the stocks that are winning. Reducing the exposure to the highest performing stocks was certainly part of the logic, but one should not discount the impact of buying losers on the way down. Let me illustrate this. And the best way to illustrate it is to compare the performance of these two, which I'll do now. I'll use RSP as the equal weight, SPY, so that we're using like for like ETFs this way. So we can see here that SPY outperformed RSP. I'm going to normalize so we can take a look at the percentages. Outperformed by about 7%. But here's what we're going to do now is we're going to take a look at the total returns over a much longer period of time. And, you know, I did a video not that long ago where I talked about the power law, you know, which is exactly this whole thing, which is, you know, to what extent does having exposure to the things that are winning and not selling, just letting the winners run and compound and grow and increase their relative size in your book, how much does that create a tailwind? And that tailwind over the long term is pretty profound. It has been, as it turns out, and this is something that I observed much earlier this year when I was looking at this whole thing, but unfortunately I'm not allowed to change these. So we're going to go like this. So you can see here that, you know, there have been periods when equal weight has outperformed. So when are you going to see, this is basically flat in here, right? We had some outperformance here and here, and we definitely got outperformance in, you know, like this bear market region right here. 2021 was a good year, as you can see. So in good years, this should probably make some intuitive sense. The cap-weighted index is going to outperform equal weight. And in bad years, like when we had rising rates in 22, so this was a down year, S&P was down, whatever, 17% or so, that's when you're going to get outperformance. So if you're leaning long and most years the market is up, that's going to be one of the challenges. So I've instead sort of come to the view that maybe if you're picking your own stocks, it's fine to have a lot of the names that are in, say, the top 50 cap weighted. And if you're really concerned about overexposure to a handful of stocks, just maybe don't include those. So would you have been crushed because you didn't own NVIDIA this year, but you did own some of the others like Broadcom? Well, no, because, you know, the performance of Alphabet, the performance of Broadcom, there's a lot of really good, strong stocks in there. Your performance would have been still exceptionally good. So just an aside, it was something I thought about throughout the year. Like, what was I thinking with an equal weight? And what are the things I liked about it? When does it work? And when doesn't it? So I thought it would be worthwhile for us to talk about that. Again, not terrible performance, but, you know, that's one of the flaws with it, and we need to acknowledge that. So I'm just going to close that and bring back some of the others. Okay. So that one wasn't so great. Moving on to another one that wasn't so great. IBIT, Bitcoin ETF. I've been saying many times that obviously, technically, Bitcoin is in a very tough spot right here. I maintain that it would not surprise me if it falls to that lower fib, 74.4-ish in Bitcoin. Doesn't mean that I'm not, that I've given up hope on Bitcoin overall. There have been multiple significant pullbacks. This one is actually, big as it is, relatively modest compared to some of the pullbacks that Bitcoin has seen historically for as long as we've all been watching it. There have been 4 that have been in the 80+% range. This one's in the peak to trough from October or so when it topped out to where we are now. It is double digits, but it's nothing like what we've seen before. But I think we do need to acknowledge that technically it's still in a tough spot. We are going to be getting information soon related to strategy, right? So MSCI is going to be making a determination about the index inclusion issue very soon. That has obviously important implications for strategy. It has implications for Bitcoin as well. From a technical standpoint, is this the point to buy it? Do you buy that chart? Probably no. you wouldn't. Would you sit there and say, okay, I'm going to add some at that lower fib, 74.4-ish, and actually I'm looking at IBIT, so I should really put so that we're all talking about the same thing. Of 74.4, yeah, I think that probably is a level down here where one could consider. It has stabilized a little bit of late, but this certainly not a chart that screams buy just yet. I mean, another potential reason that you might say, okay, I'm not going to wait for this number, but I might actually start leaning in on the long side, is this line right here. That's our 50. If it breaks above the 50, then actually that does meet our initial screening criteria. So our sort of first cut on the technical side is the 50. Is it trading above it? If it's going to be an add, like what might we add to the portfolio at any point in time? So that would be one of those things. Some of the other issues that I normally discuss don't really apply here because it doesn't have fundamentals the way some of these individual stocks do. Mike, when will you be on CNBC to reveal your 2026 acronyms? I don't know whether people have started to. There is going to be fast money's going on starting right now, and I don't know whether anybody's going to be revealing them today. There's no fast money tomorrow. The very first fast money for 2026 is on Friday, and I will be on. And I suspect I'm going to be asked to provide my acronym at that time. And so, yeah, tune in on Friday for that. Okay, what else did we have in here? SEHH already pointed out that this is, we actually compete with this thing now. This is the Schwab REIT ETF. Hasn't really been the best environment for all of these things. They've basically been flat. They pay some dividends. And what this one did, we have one also called Renty, and this one hasn't been out for the full year, but it's outperforming. There would be no reason why I would recommend buying a competitor's fund that doesn't do as well as ours does. So, not good. Safe to say, the Schwab REIT is out for 2026. That will not be appearing again. All right, let's see what else we got here. India. Now, I think there's a lot of opportunity here. I like the idea of having some international exposure. I maintain that. A lot of these businesses, it should be said, are trading at attractive multiples relative to U.S. companies. let me see if I could find this. I actually did a multinational screen. Where is that? Here we are. So just, again, you guys know that this is just something I'm doing all the time. Just looking at stocks around the world, what looks like it kind of meets some of the criteria. There's 955 stocks on this list, which I realize is almost impossible to read. So I'll try to blow it up. Let me go here. Let's take a look. Okay. Make this a little bigger. These are some businesses that, and you can see I'm looking at the same kinds of things. Like, do we have solid revenue growth over time? Is revenue growth accelerating? Do we have solid earnings growth? is earnings growth accelerating, which suggests that their business is in a good competitive spot. What kind of multiples are these things trading at? Are they, reasonably priced? And you can see that as far as Indian companies are concerned, I've got about 40 on the list. And actually, it'll be interesting to see. We'll see how many of the names in INDA are constituents, because now here's the thing about Indian stocks. They're really not easy to trade unless you're doing it through a product like this. We used to trade, we had a big internationals desk in my Cantor days. India was one of the places that for regulatory reasons required what we call boots on the ground, which meant that you had to have a local office employing local people to buy and sell stocks in the local market. So one of the reasons you would use something like INDA is that there's not a whole lot of available product out there to get exposure to that market. Now, there's a lot of things about the Indian market that I'm not crazy about. One is that the boots on the ground thing was something else that gave me a bad taste in my mouth just about doing business in that country, which is that, it was like the rubber stamp brigade. I don't know if you know what I'm talking about. What I'm referring to is that it seems like some countries, they just have so many bureaucrats and everybody's running around and you have to stamp this form and that form. And it's just, that's the measure of things. It really felt like it was a kind of a bureaucratic mess. But it's one of the largest countries in the world. It is a dynamic place. They have, some pretty compelling businesses there. So I continue to like it. Is it perfect? I mean, you're going to notice if you compare these two lists, if you can compare them. Let me do this. I'm going to sort this by security name so we can see. So you can see that ABB, which is on my list of companies that, and I haven't checked ABB, by the way, to see where it is from a technical standpoint. These screens are just on a fundamental standpoint, and as you can see in this particular spreadsheet, I'm only looking at a handful of very simple metrics. This is a really broad. Cummins India is in here. This ETF is basically like a catch-all. So there's a lot more companies in this ETF than there are in my India screen, which is to say, most of the companies on here I wouldn't buy, but I don't really have any choice. Right? So I don't have an easier way to get access to the market. So, like I said, there's 40 names that I'm interested in. There's 166 in the ETF. The good news is that it's not. Let's go like this. I'm going to just do it on a weighted basis. You can see that this is. That the top constituents of the ETF do have a disproportionate amount of it. So there's a lot of stuff down here that really isn't going to have much of an impact on it, right? So Union Bank of India, 0.17% of the ETF. Whatever happens to Union Bank of India, it's not likely going to have a huge impact on your investment performance. But, there we have it. Okay, let's move on to some of the other ideas that I had here. Obviously, Alphabet, it's up a lot. I still like it. Amazon's up a decent bit this year. I still like that. So I don't know that Alphabet is necessarily going to end up in my 2026 acronym. But if you hold it, if you happen to follow me, you're in that thing. I'm not a seller here. Gold. This is kind of our last one. This is a little bit more difficult because I'm not as enthusiastic about the precious metals now as I have been for the past several years. I still think everybody needs an allocation. Chances are, if you have an allocation to gold, and you certainly have this if you have an allocation to silver or to the miners, your allocation to these areas has probably grown somewhat. So sell it all? No, not saying that. Sell off some of just rebalance the portfolio and take it in a little bit? Yes. And where silver is concerned, I would gravitate towards the miners instead. My reason for saying this is that you may remember when gold was really taking off, the miners for a while, and we own gold miners, by the way, in one of the discretionary funds. So it's, you could say, oh, well, he's talking his book. Or I'm saying we are putting money into the things I'm talking about. If you go back in time for several years after gold had such a run, this is what I want you to look at. This is, I think, really an interesting story. And that is that, the miners who are levered to the price of gold, of course, did not appreciate anywhere near as much as gold did for, a pretty good period of time. Gold has been appreciating for a longer period of time. You can see that it really started to take off in here. This was the lows right here. And yet the miners remained basically moribund for 18 months after gold really initiated the bull market that it's currently in. Well, if we look at the silver miners, they have certainly done exceptionally well, no question. But like the gold miners, they should have some leverage to it. And yet, if we go back in time, we're going to see, I think, a fairly similar dynamic, right? So we're going to go over here to the beginning of this period. So that's where the silver miners as a group were 5 years ago. And we'll take a look at what silver has done in the meantime. And you can see that you have a very similar kind of a dynamic where the miners, this is really where the silver bull market began, back here. Same place essentially that gold did. And in a similar circumstance, the miners were basically flat for, in this case, close to 2 years over that same period. So are they sharper up now? Yeah, they are. They're up a lot, but they're not up that much really compared to where they were 5 years ago, particularly not on an inflation-adjusted basis, right? So they're up about 80%. We probably had 30%, real inflation since then. Silver is up huge. I would pull back exposure to the precious metals because they have grown as a portion of your portfolio, unless the rest of your portfolio has absolutely crushed it this year. And if it has, good for you. Congratulations. More health, wealth, and prosperity for you in 2026. And give me a call and take me out to dinner. But my point is that if you have an exposure to silver, maybe pare your silver exposure back generally, but also take a portion of your silver and deploy it into the miners. That is my thinking on that. Okay, so I think I've kind of beaten this acronym business to death. And let's see if we have any questions or things here. Tariff effect. Ordered a new Dell PC and Motorola phone. Previously there was made in China. Now PC was Mexico and phone was India. Yeah, that was certainly a portion of the intent. One of the things that, the administration said specifically that one of the things that they were trying to go after anti-competitive practices. They were trying to curb China's contribution to the fentanyl trade. And there are obviously some other political issues there as well. So China's tariffs were the ones that went up by the largest amount and to the largest amount. Well over 100% at some point. I am not disappointed to see more manufacturing in North America. Even if by North America that's not going to be the United States, it's not going to be Canada. If it's going to be Mexico, would I rather see more manufacturing in Mexico than China? All else equal, and that the machines are being made just south of Texas and then brought over the border? Yeah, that's a good outcome. By the way, anybody who's ever driven through Texas at night, especially West Texas, where the border with Mexico gets close, if you're driving, for example, from east to west, it is quite a sight because there is so much activity, commercial activity, on the southern side that it just lights up. You know, if you're going by there at midnight, and I have made that drive, many of you probably know that I lived in Texas for a time, the southern border, there's just a tremendous amount of economic activity. I think that's a good outcome, personally. And India is, for all of its bureaucratic morass that I was lampooning only moments ago, it is a democracy, a fully functioning democracy. Well, I mean, is ours a fully functioning democracy? Sometimes I wonder. But I will say that it is a democracy, and they're aspiring to do the right thing. And yeah, I would rather we bought product that was manufactured in India and Mexico, frankly. Happy New Year. Best wishes for the new year. I'm getting that from Kirk and several others. And same to all of you. Happy New Year to everybody. I'm from Tucker D. Dog and James Foreman, the covered collar. Stephen here. Bill, Dividend Degenerates, thank you very much. Happy New Year to you and Alex. I'm actually kind of surprised that all of you guys tuned in on New Year's Eve, but I'm happy and pleased that you did. So thank you for that. Gold and silver, Alex V asking, is the run over? I don't know that it's run over. I just think it's come very far. And some of the structural imbalances, I was listening to Besant talk. Who was he talking to? It was just a couple of days ago, so I'm trying to remember. Was it a podcast? These things all get sort of blurred together. Was he on Bloomberg? I can't quite remember. One of the things they were talking about was the administration's goal to get the deficit to 3% of GDP. A number we've been far, far off of for far too long. 3% deficit to GDP has been described as a sustainable level. And it's a tough one to hit at this point because the interest expense now exceeds our defense budget, which is also just a staggering thing and is so illustrative of the problems that we have. But if we can get there, which he suggests is possible, tail end of next year maybe, that we will be in the threes. Originally, their target was to get 2-3. When he spoke within the last 7 days, their target he referred to was getting to the threes, which means, as far as he's concerned, 3.9 would match. But to me, that's a big improvement. If you have a $30 trillion economy and, we can get down to, $1 trillion, $1.2 trillion deficit, relatively, that would be a big improvement from the $2 trillion that we've been running, which is not sustainable. So, yeah, would be very happy to see that. And that would slow the pace of precious metal appreciation on a relative basis, because a big portion of this have been concerns about monetary debasement. And they do not make those corrections, then monetary debasement is pretty much the only course. There's going to be either an implicit or an explicit default of some sort. Either you inflate your way out of it, or you actually have an explicit debt restructuring, which would be totally chaotic. We don't want to see that. So, let's see here. Okay, what was this question? You are asking about uranium. Michael Anthony's asking about uranium. So here is the... Okay, so just so you guys know, I've said this before. As you can probably tell, this is not typically the kind of company that I'm really looking at. They have negative free cash flow. It's pretty much a sort of a pre-revenue story. This is more of a commodity story than anything else. Just not to dismiss these things as decent potential investments, but this business in particular is not on my radar. It also is probably not quite big enough. Admittedly, I'm typically looking in the Russell 1000. You can see by looking at my global screen that I do look at a larger universe. The global number of stocks that I was screening, that I started with, and then paired to, the initial pairing got me down to 10,300 securities internationally before I got down to the 900 in here, 40 of which are from India. But admittedly, I don't typically delve into these companies that much, and that is because it's very difficult for us to trade them. An average size position that we enter into in the discretionary fund is going to be 50 to 75 million. So names like this are going to tend to be a little bit harder. It's an $11, $12 stock. You can see that for us to get into it, our position would be something in the neighborhood of 60 to 70% of an entire trading day's volume, which means we'd have to work into it over time. And more than that, we trade options against it. And that's going to be a little bit difficult to do in something like this, typically. Actually, this one did trade a decent number of options contracts. How wide are these? And then I'll also add the following, which is that I like the uranium trade. The markets are wide-ish, but not too bad. What I have typically looked at for this is URA. Not one of our funds, not a product of ours, but just a decent way to look at the uranium trade if you're interested. And I'm inclined to be in the uranium trade to some extent. I have also previously said, and this is because of the uranium, well, not uranium trade per se, this is more because of the nuclear trade, as I've previously articulated. I have also looked at Fluor. And what I like about Fluor is that the company is not incredibly expensive. They are a big stakeholder in SMR, which is essentially a pre-revenue business. You can see here the company's trading 18 times, maybe a little bit less than that on a forward basis. But more to the point, they touch the industry in a couple different ways. So they are involved with the construction, recommissioning, decommissioning of nuclear power plants, the engineering procurement process as well. Is it really a growing business? No. As I think I've probably previously mentioned, sometimes I have exceptions. We have what we call a special situations sleeve, which is, other things that we are interested in investing in, even if they don't strictly meet some of the other screening criteria, because they're a special situation. This would be an example of that. So no problem with you making a bet, Michael, on Uranium Energy Corp. Negative free cash flow, no earnings, not really for me. I'm going to follow the space with some interest, have some exposure to it here. We actually do have some exposure to SMR as well, which that was not my call because I kind of prefer the Fluor play on that, but it's going to be a part of the future. As we think about energy, we need to keep an open mind, and I think nuclear does play into that. That brings up another point which Mark Guthner brought up yesterday on Office Hours. You can go back and watch that video from yesterday if you're interested. But he was also talking about the use of silver in anodes that Samsung has supposedly developed a much more efficient battery than the conventional lithium-ion type, uses silver in the anodes, so there is an industrial push behind it. So Michael Anthony is then saying, where's my cursor? Oops, there we are. So Michael is also saying, doesn't the USA need uranium for power, and is the reason I bought it? You know, the world needs uranium. It's not just the U.S. You know, population continues to grow. Energy demand continues to grow. Data centers alone are a huge increase in that. Take a look at power consumption in China and power generation capabilities in China, and it's just off the scale. I mean, China's generative capacity far outpaces our own and that of Europe. Unfortunately, their emissions do too, which brings up the other side, which is, you know, why is it that all of us should assume that uranium is going to play into this? And that is because I assume nuclear power is going to play into this. So, yeah, I am bullish uranium and on nuclear as a part of that overall trade, and that was fine. And one additional point you're making there, you're saying that it has no debt. That's fine. Let's see how much debt they have, if any. They don't have any debt. You're right. They have $146 million, $147 million in net cash. But they have negative free cash flow. Negative free cash flow for the full year actually is going to be, as you can see, so they have to do a capital raise somehow, right? Let's just take a look at a couple of things. So it's true they have no debt now, but they've got $146 million in cash. We've got another $80 million or so in negative free cash flow through the end of this fiscal year, which ends in July of next year. And then they're still forecast to have another $155 million in negative free cash flow the year after. So if we break that down into quarters and we say, okay, well, what's that going to mean by year end 2027, right? We've got, call it 38, I'm just going to round up and call that 80, 130, 160, and we'll call it 3/4 of $190. $190 million in negative free cash flow by the end of next year. And they've got $146 million in cash. So they have got to do a capital raise. Again, there are a lot of businesses that did not make money and didn't have positive cash flow that turned into something great. When Facebook was not a profitable company when they IPO'd, wouldn't have been a bad business to buy. Wouldn't have been a great time to buy it. They traded on the syndicate bid their first day on the IPO. I talked about that a little bit on Fast Money actually recently, but I don't think anybody really knew what I was talking about. But yeah, I mean, I've got nothing against businesses like this. That is totally fine. It's just not for me. I'm not recommending, I don't go out and buy or recommend other people buy these kinds of speculative businesses. To me, it's a little easier once they've begun to prove themselves. And I've been burned, by the way. It's not because I've never had a taste for, more speculative VC investing. Take it from me, the most painful thing I've ever done was invest in early stage businesses. And I'm pretty much done with that because of it. So that's all I'm going to share on that. But if you're going to make any kind of a New Year resolution, why not say, I'm going to invest in businesses that have proven themselves? Is it really that hard? I don't know. I mean, everybody has their own goals, needs, and whatever. But for me, I'm just going to look for businesses that have proven themselves before allocating any capital to them. Okay, so I think we're done with UEC for now. I'm happy to answer your questions about that, what little I can, because I don't know that much about the business, as I've just previously pointed out. But we are going to have an acronym to talk about I imagine on Monday, because I'm going to be on Friday, and I'm going to have to give them. I'm guessing I'm going to have to give them an acronym for that. I will do, and then we can delve into those ideas in greater detail on Monday's open mic. So until then, everybody, Happy New Year. Thanks for tuning in right before the holiday, and I'll see you next year.